Welcome to the Deep Dive, your shortcut to being really well informed. Today, we are tackling something that hits close to home for pretty much everyone taxes. You know that feeling, right? You earn a good income, say $200,000, but then maybe $80,000 of it just poof, gone to taxes. It's frustrating. You work so hard, and then a big slice just disappears. But what if, and this is the big question, what if we could flip that script? What if the tax code wasn't this enemy stealing your money, but more like a partner, a roadmap even, designed to help you build wealth? So our mission on this deep dive is to figure out how the wealthy, how top entrepreneurs legally slash their taxes, and more importantly, how you can start using those same plays.
Exactly. And for this, we're leading heavily on the insights from Tax-Free Wealth by Tom Wheelwright. Now, Tom's a pretty big deal in this space. He's a CPA. He was a Rich Dad advisor for Robert Kiyosaki, Rich Dad, Poor Dad. His firm works with thousands, literally thousands, of entrepreneurs and investors across the globe, so he's seen it all. And just to be super clear, this book isn't about shady loopholes or anything like that. It's framed as a blueprint, really. Building wealth while paying less tax, totally legally, just by understanding how the system is actually meant to work.
Okay, let's dig into that core idea then, because it really goes against how most of us think about taxes, doesn't it? We usually see them as just this unavoidable cost, something you just have to pay. But Wheelwright says the tax law is a series of incentives. That's a big mindset shift right there.
It absolutely is. Think about it this way. The government doesn't just want your money. They use the tax code strategically. They want to encourage certain things, stuff that grows the economy, like creating jobs, right? Or building more housing, developing energy, investing in R&D. If you do those things the government wants to see happen, the system is set up to reward you. That's where deductions and credits come in. They're rewards for playing by the rules they've set out. And here's the key insight, I think. The really wealthy people, they aren't necessarily cheating. They're just following the rules, maybe better than everyone else. They understand the incentives deeply. Take Amazon back in 2018. Huge profits, like $11 billion, right?
Yeah.
And they paid zip, in federal income tax. Now, it wasn't some magic trick. It was because they poured money back into things the tax code rewards. Massive R&D spending, big investments in green energy, creating tons of jobs. They just knew the playbook and used it.
Okay. So the takeaway isn't about finding ways around the system. It's about working with the system, using it strategically. Stop seeing taxes purely as a penalty and start seeing them as instructions almost. Instructions for how to build wealth in ways the government actually supports. It means changing your actual financial moves, not just, fiddling with TurboTax at the end of the year. But how does someone who isn't Amazon apply this? How does this work for, regular people or small businesses?
Yeah, that's the crucial connection. And the good news is the principles scale down. Wheelwright really stresses this. The core idea is the same whether you're a giant corporation or just starting out. The tax code fundamentally rewards the actions, investing, creating, providing services. So the strategies we're about to get into, they're definitely applicable, even if you're just running a small side gig.
Got it. That makes sense. And this brings us to what Wheelwright calls maybe the biggest tax mistake most people make, which is staying only as a W-2 employee, just getting that regular paycheck. If all your income comes that way, your options for deductions are they're really limited compared to other ways of earning.
That's exactly his point. He contrasts the formulas, right? For an employee, it's pretty much earn drashed, get tax benched, spend what's left. Simple, but limiting. But for business owners or investors, the sequence is different. It's earn strategies, earn spend on deductible things. Get taxed on what's left over. See the difference. You get to subtract your expenses before the taxman takes his cut. That's why shifting some of your activity into business ownership or investing, even if it's small, even part-time, is so fundamental for tax freedom. It flips the equation. And another really interesting distinction he makes is between tax preparation and tax strategy. Preparation, that's like, bookkeeping after the fact. Recording history, you look back at the year, add it all up, figure out what you owe. Strategy, though, is forward-looking. It's about designing your future. It's about planning things before they happen, structuring deals, making investments with the tax implications in mind to legally minimize the tax hit.
Right, that proactive approach, it changes the whole dynamic with your accountant, doesn't it? They're not just historians tallying up the past year. They become architects helping you build your financial future. You hear about wealthy folks meeting their CPA all the time, not just in April. They're planning, structuring deals, setting up entities before money changes hands, right? To make sure it's tax efficient from the get-go, being strategic, not just reacting.
Okay, so step one is this mindset shift. And step two is understanding the structural advantage of business and investing. What are the actual levers we can pull? Let's get into those 7 big strategies Wheelwright lays out for cutting taxes. All right, number one, start a business. even a tiny one, a side hustle. This isn't just about the extra income, though that's nice. It's the key that unlocks a ton of potential deductions. Suddenly, expenses that were just personal costs might become legitimate business write-offs. Think about that home office space, or part of your internet bill, your phone bill, car mileage for business trips, even some meals if they have a clear business purpose. Like, say you start a small consulting gig from home.
Part of your rent or mortgage interest, deductible. That instantly changes your tax picture.
Yep, hugely powerful. Okay, number 2, use depreciation wisely. This is a big one, especially for real estate investors. You've got concepts like bonus depreciation. When you buy a rental property, you can't deduct the whole cost at once, right? You depreciate it over time. But there's this thing called cost segregation. It sounds complicated, but basically it lets you identify parts of the property like carpets, appliances, landscaping that wear out faster than the building itself. And you can depreciate those parts much quicker. Sometimes using bonus depreciation, you could deduct, say, $80,000 or even more in the first year on a $300,000 property. This is how landlords can legally show a loss on paper, a paper loss for tax purposes, even when they're actually collecting rent checks and making cash flow. It shields that income.
Wow, okay. That's significant. And sticking with real estate, strategy number 3, real estate professional status. This sounds like it could be a game changer, especially for higher earners.
It really can be. Normally, losses from rental properties are considered passive, and you can generally only use them to offset other passive income. Limits apply. But if you or your spouse qualifies as a real estate professional, which means spending a significant amount of time, like over 750 hours a year, and more than half your working time, actively involved in real estate businesses, then those rental property losses, including those paper losses from depreciation we just talked about, are no longer passive. You can use them to offset your active income, like your salary from a regular job. That can drastically cut your overall tax bill.
Okay, that's huge. Makes sense why people focus on real estate. What's number 4?
Number 4 is all about leveraging pass-through entities and the right structure. Basically, how your business is legally set up matters. Are you an LLC, an S Corp, a C Corp? Choosing the wrong one can literally cost you thousands extra in taxes unnecessarily. A common example Wheelwright gives is for consultants or freelancers making, say, 6 figures. By setting up as an S Corp, instead of just being a sole proprietor or a simple LLC, they can often save maybe $8,000 to $12,000 a year.
How does that work?
Well, as an S Corp, you pay yourself a reasonable salary. That salary is subject to self-employment taxes, Social Security and Medicare. But any profit the business makes above that reasonable salary can be distributed as dividends, which are not subject to self-employment taxes. That's where the savings come in.
Ah, clever. Okay, number 5 is interesting, especially for families. Use the tax law to create jobs by hiring your own kids.
Right. This sounds maybe a bit cheeky, but it's perfectly legitimate under the U.S. tax code. If you have a real business and your kids genuinely do real work for that business, things like helping with social media, filing, cleaning the office, whatever is age appropriate, you can pay them a wage. And if they're under 18, for federal income tax purposes, up to a certain amount each year is around $13,850 in 2023. But it adjusts that income can be tax-free to them.
And deductible for the business.
And deductible for your business. So you're basically shifting money you might have given them as allowance anyway into a tax-deductible business expense. Plus, you're teaching them about work.
I love that. Okay, number 6, invest in energy incentives.
Yeah, this is becoming increasingly relevant. The government really wants people and businesses to adopt cleaner energy. So they offer some pretty significant tax credits and incentives. Think solar panels for your roof, buying an electric vehicle, maybe investing in larger clean energy projects. The federal solar tax credit in the U.S., for example, can be around 30%. That's a direct reduction of your tax bill, dollar for dollar. Plus, you save on energy costs long term. It's a clear win-win.
Makes sense. And the last one, number 7.
Number 7 is a bit broader. International and retirement strategies. This covers the more traditional long-term stuff like maximizing your contributions to retirement accounts, IRAs, 401k, using Roth strategies where it makes sense for tax-free growth later on. And then for businesses looking to expand overseas, it's about setting things up correctly from the start. Proper international tax planning is crucial to avoid getting taxed twice on the same income and making sure your global operations are efficient tax-wise.
Okay, so when you put all those pieces together, the business structure, the depreciation, the hiring, the incentives,
yeah, you start to see the bigger picture. It connects back to what we said earlier. The wealthy aren't just reacting at tax time. They're playing offense strategically all year long. They're proactive about setting up the right entities. They're analyzing investments through the lens of tax incentives. And they have that ongoing relationship with a CPA who's also thinking strategically, not just historically.
There's a great quote from Wheelwright you mentioned. If you want to change your tax, you have to change your facts. That really sums it up, doesn't it?
It really does.
You can't just wish for a lower tax bill or buy fancier software. You have to fundamentally change what you do, how you earn your money, how you spend it, where you invest it. Those are the facts that determine your tax outcome. So let's wrap this up. The big takeaway from this deep dive really seems to be, stop fighting the tax code. See it for what Wheelwright argues it is, a guide, a set of incentives, pointing you towards wealth-building activities. It's about moving beyond the very limited deductions you get as an employee and stepping into the world of business and investing where the real opportunities lie.
Couldn't agree more. Those big wins we talked about, properly expensing business costs, leveraging real estate depreciation, choosing the right entity structure, using energy credits, they're all there in the code. They're meant to be used. The key is being proactive, planning ahead. And seriously, talk to your CPA more than once a year. Make them a strategic partner.
Okay, let's give everyone listening some concrete next steps. An action plan. How about this? This week, maybe think about starting that side hustle you've been considering. Just taking the first step unlocks those potential deductions. Or book a meeting, not just with any tax preparer, but with a tax strategist, someone focused on planning. And maybe just pull out last year's tax return and look at it with these ideas in mind. See what might have been missed.
Good starting points. And then, maybe over the next 90 days, think bigger. Could you set up the right legal entity for your side hustle or business? Could you explore making your first move into real estate investing? Maybe look into those energy incentives. And definitely work with that tax strategist to map out a plan, maybe even a tax strategy calendar for the year ahead, about building momentum.
Absolutely. Which leaves us with a final thought for you to ponder. After hearing about all these powerful legal strategies the wealthy use, how might you start to rethink your own approach? How could seeing the tax law not as an obstacle, but as this detailed roadmap, change your financial future? Something to really chew on. We hope this deep dive gave you a brand new lens.